Tim, thanks for being with us today.
Great to be here.
Tim, for viewers new to the story, what is Medalist Diversified REIT?
Medalist is a real estate investment trust. We went public in 2018. We purchased a diversified group of properties. We have done that since we started as a private equity firm in 2003. The reason we want to be diversified is because we believe that in a recession, diversified portfolio is going to hold up a lot better than just one single asset portfolio. I mean, my gosh, if you look at what's been happening in the pandemic, if you were only a hotel REIT, you would have a lot of problems out there. We have held up because we have flex industrial, we have neighborhood shopping centers, a couple of hotels. One's doing really well, the other one is dragging a little bit, but we have held up well in the pandemic. Completely turned the corner on the pandemic, and we have reinstituted a dividend. We're going to pay 2 cents a share for holders of record on August 2nd. The payment will be on August 5th. So we're definitely in business. We're back in business. We've turned the corner. We're very excited about the future.
Okay, so you have overcome the challenges of COVID then. So your properties, what is the occupancy rate?
Yeah, we completely turned the corner on the pandemic. All of our commercial properties have positive cash flow. One of the hotels, our Clemson, South Carolina Best Western Hotel, has positive cash flows since we have leased that out to Clemson University. And as I said, we have one hotel for sale, the Hampton Inn, and that should settle sometime in August. We should net about $2.4 million in cash out of that sale after we pay off the debt.
Okay. Well, you did reintroduce the dividend for the common stock, the 2 cents per share. Congratulations.
Thank you.
And it came a little more than a month after you announced your dividend for the second quarter of 2021 on your preferred stock at 50 cents a share. How were you able to do this? Because, again, you didn't pay a dividend on the common stock for over 4 quarters. So
we had to suspend the dividend on the common stock because of the pandemic. We had to hoard cash to make sure the portfolio stayed afloat, which it has. As I said, all of the commercial properties are now cash flowing very well. And the directors and management considered cash flow when we declared the new common stock dividend, and we believe this dividend is sustainable. So we were very comfortable with 2 cents a share for the second quarter.
It's excellent. And I have to say, and of course you are a client company of Red Chip, but the stock today, in my mind, and compared to other REITs, is very undervalued at this point. I think it's just a matter of investors understanding that you're now paying a dividend again and that you will continue to. I think that's very important. I think once the street understands that, I think you'll see the stock trade more in line with where it should trade.
Oh my gosh. I mean, we are having positive cash flow on all our properties, except for the hotel. It's very minor negative cash flow. And as I said, it's for sale. We'll net $2.4 million cash out of that sale. We're going to pay a dividend on August 5th for people of record August 2nd.
Right. And that 2 cents a share on the common, what is that dividend yield today?
100,000 shares, 6.6% yield.
6.6% yield given where the stock's trading today. That's not bad at all. Now, you also acquired the Lancer Center. It's a retail center with about 179,000 square feet of gross leasable space in Lancaster, South Carolina. Tell us about that acquisition. How does it fit into your overall vision?
So we bought Lancaster Center, 179,000 square foot shopping center in Lancaster, South Carolina, as you said. Pro forma cash flow on that center, 9%. Positive cash flow. We're getting ready to buy a flex property in Chesapeake, Virginia, 90,000 square feet, with pro forma numbers at a 10% cash flow. That contract is listed at 8K on the SEC website, so it is public information. The settlement on that property is imminent.
Okay. Let's talk about your business model for a minute. You're buying properties in secondary markets. You've been very successful in the past. You and your management team have had other REITs that have done quite well. So let's talk a little bit about your business model and your background.
Sure. The business model is to purchase workforce necessity real estate like we have in the past. We're used to being a diversified portfolio. We started out that way in 2003. We've purchased all the 4 property types I've mentioned over the years and managed them with 2 different property managers in place. One is Dotson Commercial Properties that manages all our commercial properties, and one is Marshall Hotels and Resorts that has managed our hotel properties. We started the company as a private equity firm in 2003. Bill Elliott and I became 50-50 partners in 2003. We used friends and family money as equity up until 2013 when we started an organized fund called Medalist Fund 1. Medalist Fund 2 was started in 2015 and is still in existence. We went public in 2018 with Medalist Diversified REIT, and since then we've raised $55 to $60 million in equity. So we're a diversified REIT focused on necessity real estate, and we like to call workforce real estate. Not a type A office buildings or type A multifamily, but more for the workforce.
Let me back up, because sometimes we'll get questions about why is this REIT buying, shopping malls or strip malls when retail's moving so quickly online. And some people believe, these shopping malls are a thing of the past. How do you comment on that?
Yeah, sure. There are shopping malls out there. There are shopping centers out there. We're buying neighborhood shopping centers with things like pizza parlors and fitness centers and dry cleaners and grocery stores, places where you have to go. Necessity shopping centers, necessity real estate. We're buying flex industrial properties. It's basically a community that's 1 story high, and every unit has a loading dock on the back. So, ergo flex, where each unit can either be all warehouse with a loading dock, half warehouse, half office, or all office. So we have had a lot of luck with that in the past. We've owned over 1.5 million square feet of it over the last 17 to 18 years.
Tim, what's the essential value proposition for investors today? Why should they take an interest in the stock today?
I mean, we've got a $19 million market cap. We have 7 properties getting ready to have an 8th, and 95% of the properties are cash flowing well. Our goal is to create cash flow to pay out dividends. We just reinstated our dividend, 2 cents a share. It's going to be paid on August 5th for the second quarter. We're expanding our portfolio. We're buying and seeing great cash flowing properties that we're going to continue to purchase to boost cash flow, to pay a dividend, possibly increasing the dividend over time. The properties in the portfolio have great value and are cash flowing extremely well.
It's a great story. It's clearly undervalued. Tim, thanks for being with us today.
Great being with you, and for the audience, we hope you'll invest with us.